At this point, the Federal Reserve should probably call Ghostbusters to fight the inflation that they're looking to tame down, because their latest rate hikes aren't doing it. The Hollywood writers are on strike this week. Not surprised. One of their main concerns is the use of artificial intelligence in doing their job. Regional bank failures left and right, and plenty still left in peril. We're going to see what happens here as these regional banks play a pivotal role in our economic society. And residential real estate, low inventory, the double-edged sword. It's the number one reason values are holding, and also the number one reason the market is slow. Welcome back to This Week in Mortgage, everybody. My name is Sam Battaglia at Mortgage Black in Beverly Hills. I hope you had a great week. All right, the Federal Reserve, call Ghostbusters. Raising interest rates is not going to fight the ghost of inflation, that they are just going to swing themselves, rope-a-dope, swing themselves out of this one here, because this last rate hike borders on the absurd. The same week, we've got another, big major bank failing and being taken over. They raised rates. I'm not exactly sure what they're doing or what they're looking at this point, but there's a lot here. So let's talk about inflation. I'm going to break it down into two different categories, high dollar and low dollar inflation. Low dollar inflation would be a bag of potato chips going from $1 to $1.50. High dollar inflation would be a car payment going from $600 to $900. Same percentage, just high dollar and low dollar. I think the Federal Reserve needs to start differentiating inflation in potato chips, food and energy, and on a car payment, durable, consumer goods. Because they are fighting low dollar inflation by destroying the high dollar demand. Literally does not make sense. I want to take a look at a couple of things. Oil, just until today's Friday, of course, was below $70 a barrel. I expect it to go lower. Gold, however, is over $2,000 an ounce. I expect it to go higher. I don't have to explain to the Federal Reserve what these two numbers are. They need to look at them, and they need to chill out. I've also got a question for the Fed. Did they ever ask themselves how long it would take for all the money they dropped out of the helicopter to work its way through and out of the system? Because if they did, they would realize it's going to take about 4 years from the last dollar that was dropped out of the helicopter to work its way out of the economy. They did not wait it out. They should have been more patient. And like I said before, years ago at this point, they had it right. Inflation was transitory. They just got scared of the price of a gallon of gas. Federal Reserve said something. The chairman said something very interesting on Wednesday after they raised that last 0.25%. And I quote, and I'll give you the context, but I quote, "No one should assume the Fed can protect the economy." Okay, that's kind of your job. And the context of this, in all fairness, was he was addressing a default by the government on our debt, the debt ceiling, when he made that statement of no one should assume the Fed can protect the economy. I've got a problem with that statement, and I hope I'm taking it out of that context, and I hope I'm not making a false correlation. Yeah, we should assume you're going to protect the economy because that's your job. That's like the security guard at the bank at night saying no one should assume I'm protecting the safe with all your money in it. Yeah, we should. They are in charge of the economy, for better or for worse, and they need to protect it. Regardless if they cause the issue, they should step up and use what resources they have if we do end up defaulting. But I really don't like the tone and tenor of that statement regardless of the context. Yes, we should assume that you're here to protect the economy. I think the solution to interest rates stop going up would be if the Federal Reserve actually went shopping and went and bought a car. I hope one of the Fed governors or the Fed chairman's cars is on lease and it's coming due and they go to buy a car and they go buy the new model of the same car that, all things being equal, would have been $30 or $40 more a few years ago with the new model. Now it's probably, could be double. But it's definitely 50% higher in terms of the payment. And they need to go shopping and step into the real world for a quick second and see what they've done and how it's affected things. And like I said, this last 25 basis point hike this week has crossed the line of absurd, the last 50 for that matter. But in all fairness, I will give them this. That is their insurance policy, because when they cut, they're going to go at least 100 basis points. Two quick little notes. Somehow the jobs report for April, as a side note, it was so-so. Not impressed, not an overheated number like Wall Street is assuming today. And something else on top of that, they revised down the previous 2 months. We've probably peaked on job creation. We will see. And then, of course, moving towards the debt limit June 1st, let's hope everybody in Washington can play nice in the sandbox so I don't have to talk about what happens after we default on our debt. Moving on to the Hollywood writers' strike. So, artificial intelligence, here we go again. The Hollywood writers, a lot of my clients, some of the smartest and most creative people in the world, and they recognize the danger that artificial intelligence has at the way they earn a living. Very interesting. One of their main concerns and one of the main negotiating things is to limit the amount of AI the studios and whoever can use when putting together a script, for instance. Very interesting. I bet you right now the studio execs are hiring computer programmers, some of the smartest in the world, probably fighting with the big tech companies, to get some computer people in there to see if they can actually write scripts for TV shows and movies, and maybe just have one non-union member edit it. But the fact that the Hollywood writers are scared of artificial intelligence should scare all of us beyond, especially somebody like me who deals with numbers and black and white every day. And like I've said before, artificial intelligence doesn't buy houses or consume goods, and that is not good for the economy. Moving on to the regional bank failures. Regional banks are the backbone of the financial system. For example, if a corn farmer, or a corn husker for that matter, and maybe my friends from Nebraska can clarify this for me, but corn farmers in Nebraska do not get their money from big money center banks in New York and California. They get it from small, local, regional banks. Citrus growers in Florida do not get their money from big money center banks. They get them from regional banks and local banks. These local banks walk the property, something big banks don't do and can't do and don't want to necessarily do. And the fallout of this week, as we saw, too big to fail, just got bigger, which is not a safe play. And moving on to some more exposure for the regional banks, which the Federal Reserve needs to understand, is the office space problem that has peaked its head. Moving into the residential side of things, I'm also going to connect office space to this. So right now is a great time to get office space in New York and San Francisco, two of the biggest money centers in the world for that matter. Less than 50% occupied, not good. Guess who has the majority of the loans on those office spaces? Regional banks. Not good. This is very dangerous. The Federal Reserve is playing a very dangerous game right now. So, like I said, there are going to be office conversions into residential, and we need it because inventory is low. And like I mentioned, the number one reason values are holding is because of low inventory. And the low inventory, I'm telling you right now, even though we have less transactions, it's a blessing in disguise, because where these rates are, if we had a lot of inventory, values would be severely hurt right now. And like I've always been saying for the last couple of weeks, something about the 5%, the consumer's appetite opens right up and their eyes get big again. And I think we're probably headed back to the 5% on a 30-year fixed. And when it comes to the next month or so of the economy and what's going on in Washington, I would have to say get ready for a very interesting ride. Okay, everybody, that is my show for this week. I hope you enjoyed it. As always, any mortgage-related questions, please don't hesitate to reach out to me. Friday again, here in LA. It's sunny again. Everyone have a nice weekend. Take care of yourselves, and thank you as always.